Auto-callable funds explained. High income, but what's the catch? Yield, risk, we're going to answer them all today.
Hey everyone, welcome back to the channel. I'm Doug, the Retirement Guy, and today we're going to tackle something that a lot of people don't understand, have not known. And these have been out for a little bit of time, and it's called auto-callable funds. They're not ETF funds, they're not mutual funds. These are a unique piece, and they are actually generating a lot of high income. But we always ask, what's the catch? What's going on with it? So today we're going to do a deeper dive into it, give you the risk of the funds, explain how it really is designed to work. And then we'll do a follow-up video that's going to give us more of a detail of each and every fund that we deal with. So let's get into today's video. I think you're going to like this one, the auto-callable funds explained.
Important investment disclaimer. This is for educational purpose only. This is not financial advice. Distribution risks, distributions are not guaranteed. Yields are not guaranteed. They're always subject to change. So always be on top of your investments and always talk to a professional consultant before making any financial decisions. Same thing with tax purposes. So I think the biggest question everyone's asking, what are auto-callable funds? Well, auto-callable funds are structured notes issued by banks. They're not ETFs. They're not monthly mutual funds. Their performance is tied to a stock, an index, or a basket of stocks or indexes. So what the key features are is this. They use a regular coupon payment. So this is what we got to watch for. These are not dividends. It's a periodic income payment based on embedded option strategies. Auto call feature is an early redemption if underlying asset reaches predetermined levels, often within 1 to 3 years. So I'm going to explain to you real quickly in my terminology to it. The auto call feature is if the fund takes off and does really well and it achieves its predetermined level, they can do an auto call the notes in, pay them off, and cash out on the fund. So that's trying to help the upside. Now, of course, the upside will be capped because of the options that they sell, but it helps them to reestablish itself to gain more of cap upside. Now, the selling feature of this is the downside protection. The principal protection only if the asset stays above the barrier throughout the term. And we'll explain that here very quickly. So the key features again of the funds, auto-callable funds are defined in 3 core structure features that makes it different from traditional investments. The first one is going to be regular coupon payments. Periodic income based on underlying assets performance. It's generated through embedded option strategies and is paid if the asset remains above the coupon barrier. So I can only do this by trying to explain to you what it works with if it was an ETF. But again, they're not ETFs. These are not dividends. The income is the premium from assuming market risk. So they're going through and they have embedded option strategies in every one of the funds. It's all predetermined. It's all set how they're going to do it. They have everything marked out, the what ifs and what happens and all that through it. And then they have periodic income based. I've seen some do monthly. I've seen some do quarterly, across the board. But it's how well the underlying asset's going to perform. The auto call feature is the early redemption if an asset reaches the auto call level, usually 100% of the initial value. So again, another estimate. If I bought a fund, and we're just going to say that this is an S&P 500 fund that we bought, and they say if the S&P 500 gets 100% growth, basically doubles its size, they can do an auto call on the item to basically they're going to reset everything. You're going to get your money back. You're going to get your investment back. You're getting all of the, everything that you've gained from it. But then they're going to take it around and reset the whole package and reoffer it again. Now, is that going to happen in 1 year? No, it's probably going to be happening in that 1 to 3 years. It provides liquidity and capital return before maturity. So the downside protection, was the unique thing. And I think a lot of people see this one. It was originally I'll tell you what was built around these things. And that was like annuities were built around this. It includes a downside barrier of 70 to 80% typically. So full principal if the asset stays above the barrier. So conditionally, it's not guaranteed protection. The protection only if the asset stays above the barrier throughout the entire term. So auto-callables, is this something brand new? Is this just some new strategy that they're coming up with? And the answer is actually no. Auto-callables emerged in the early 2000s, becoming the mainstream in Europe first. So before they got into ETFs, mutual funds, they had auto-callables. It expanded rapidly into the U.S. market after the 2008 and 2009 financial crisis. So in early 2000, large European banks, especially in France and Switzerland, began issuing structured notes that paid those enhanced coupons and could be automatically redeemed or called if certain conditions were met. In 2013 to 2018, the entry into the U.S. market, U.S. banks and broker dealers began distributing auto calls more broadly. Okay, this went through the broker dealer networks. Registered structured notes products became more standardized, and quarterly and monthly coupons began to pop up. So to define the call and barrier levels, this is when many U.S. investors first encountered them. And then in 2020 to the present, it's had huge rapid growth. And that is the lower rate policy after COVID dramatically increased the issue. The auto-callables became one of the largest segments of the structured product market. And this is actually larger than ETFs as a whole, just because of everything they bring to the table. And it used to be just always banks were able to do this, brokerage houses were able to do this. This wasn't open to the retail investor. And that's what's really changing now. And this is why auto-callables are starting to become very popular, is that it's giving you strong income with downward protection, and just giving you something different to work with. So the step-by-step how they work. Well, first off, the investment setup. An investor allocates, I'm just using a number here, say $10,000 into a 3-year auto-callable note with the following parameters. Maturity is in 36 months or 3 years. Observation, quarterly payments every 3 months. Auto call level, so if the thing basically doubles in size, then they're calling the note in, and the barrier downside is 70% of the initial value. So the coupon payment mechanism, 10% annual coupon distributed quarterly at 2.5% per quarter. The conditional payment is based on the underlying asset's performance, and there's no dividends, so it's generated from embedding option strategies. So remember that. This is not dividends we're working with. This is pure income that you're getting back. And it's all, the coupons are all set up differently, what they're looking to evaluate across the board. So step 2, the auto call feature. If the underlying asset closes at or above the auto call level, which is at 100%, on any observing day, the note is automatically redeemed. The investment ends early, often within 1 to 3 years. The investor receives the principal back. The accrued coupons are all paid, and it's done. So they're then turning around and resetting for another auto call fund to go out. So the downside risk, if the note is not auto called, the outcome depends on the underlying asset level at maturity. So above the barrier, the asset above 70% is paid in full and returned. If the below the barrier asset is below 70%, the principal lost is in proportion to the decline. So where does the income really come from? Well, high yields offered by the auto-callable funds come from a sale of options by the issuing bank, not traditional interest or dividends. Selling call option limits the upside potential. It captures the gains if an asset rises, and the banks profit from those premiums. The premium selling of the put options. The premium mechanism for high income exposes investors to losses if the assets fall and creates conditions of downside risk. The option spread, more complex structures. Selling a put at one strike and buying a put at a lower strike, it reduces the strategy cost while maintaining the risk exposure. So what you basically have done is you're taking your investment into this auto-callable fund, and they're saying they're going to do it every which way to generate income, profits for the bank through the premium, and they're paying out what they say they're going to pay. And then they're also buying and selling put options across the board to help cover the downward side. So the hidden risk, and that is the issuer credit risk. The bank obligation. Auto-callables are unsecured debt obligations issued by the bank. Their performance depends on both the underlying asset and the bank issuing's health. If it fails, investors may lose principal, even in an index has performed well. There is no FDIC or government protection of this. The investor becomes unsecured creditor in bankruptcy. In 2023, Pure Wolf LLP had losses in the Bank of America and Citigroup auto-callable notes, citing issuer credit risk as a key factor in the principal value. So you need to make sure a bank is well established that it can handle these type of investments. So the limited liquidity. Auto-callable funds are not listed on exchange and are not traded in secondary markets. Early sale difficulties. Investors must rely on the issuing bank or the dealer to buy back the note, often at a significant discount. So basically, if you want to get out early, you're going to basically sell it to someone for a big discount to get out of it. So already the question is, why would you want to be in this? If these are the negatives to it, what is it? Well, we're hoping that we're going to get an income over the 3 years of bigger growth than we currently get with ETFs. The complex payoff structure. The complex structure pays off an audible notes depend on multiple embedded conditions. The coupon barriers, the auto call levels, the observation dates, and the knock-in triggers. So the barrier differences. A note with a 70% barrier behaves differently with one with a 65% barrier. And then the observation, annual versus quarterly, or even monthly, leads to different auto call timing. So according to the SEC and the FIRA, many investors do not understand these structures, leading to misrepresentation, unsuitable recommendations, and unexpected losses. Now, even with this being a huge market, you have to be on your game. The opportunity cost. And what is opportunity cost? While all callables have high income and stable markets, they come in a hidden cost, which is the capped upside. Okay, this is forced to reinvest at a lower yields if rates have declined. So if this thing has a downward trend, it's going to be very hard for it to gain up because of the capped upside. Now, auto-callable funds versus income ETFs. Auto-callables are structured notes. Banks issued debt obligations with complex strategies. Income ETFs are exchange traded. They're traded daily on major market exchanges like stocks. The credit risk. We got to deal with the bank dependency. Issuer fails to cause losses. Transparent NAVs. The daily published net asset value is in real-time pricing. So everything in ETFs is wide open book, while the auto-callables are kind of a closed book, is only for a select group to come in. Limited liquidity, no secondary markets, difficult to sell out early, while ETFs have the daily liquidity that you can buy, sell, trade in market times. Defined income, predictable coupon payments based on the option strategy. And on ETFs, it's market-based income. Distributions are driven by the underlying holdings and performance. So the positive that you get off of this is you have that defined income versus the unknown income of ETFs. Who are the companies we're dealing with? Well, these are the three biggest ones out there. And each one of them, you can look at, they have S&P 500, they have NASDAQ openings. Innovator basically has the SPYI, QQQI, IW. So they got the Russell 2000, they got the NASDAQ 100, they have the S&P 500. So realistically, most of the companies out here are really dialing into either large cap stocks or NASDAQ 100 or the S&P 500, working off of that. So again, it's one that they're going to set up, establish, and work with you to try to get you set up income over the next 3 years. Like Innovator has 100% downside buffer. So they have a lot of different packages to work with. The one fund that I started to do some research with and got a lot of information on, and this one here is CAIE. And this is the Calamos Auto-Call Income ETF. So this fund came out June 25th of 2025. And I started looking at it. It says, yep, you got $572 million in assets. And you got over 21 million shares outstanding. They've paid $2 in distributions so far. And it actually pays out monthly. So when I started really looking at this one, saying, is it really worth an investment? Well, since inception, they're at 32.54% return. That includes distributions. So this one has a 60% coupon barrier that will lead to a decline. Basically, will need to decline by 40% before that barrier will actually kick in. So a lot of security. It's a safer bet that they have out there. But again, if we're having a 40% drop off, is it really that good of a fund? You look at year to date, they're up 8.52%. Again, a nice solid run so far, but you got to count on this to be a 3-year run to really evaluate what's going on. Their average distribution is about 33 cents per month. And you can see they have a strong 1 month and year to date numbers. So who should consider auto-callable funds? Well, these funds are appropriate for investors seeking predictable high income. So investors seeking monthly or quarterly income streams significantly higher than traditional fixed income securities. Now I'm going to stop you right there to make sure you understand when I say high income. We're not talking 30, 40, 50, 60% income type pieces. We're talking things that are going to be higher than the fixed income, which is about that 3 to 6% category. So if this one came in at 7 to 8%, that is actually high income for them. Long-term investment horizon. If you're typically looking for a 3 to 5 year growth of a fund, it's best suited for investors who want to lock up capital for a defined period and don't need short-term liquidity. So this is money that you're not going to worry about. You're just going to put away and collect money onto it and not have to worry about it, overall valuation. Now, if you're into flat and mildly raising markets, this product optimizes for stable and slightly positive market environments. So it's not looking for markets to take off. And I'm going to use the AI point of this one. If AI takes off and doubles in 5 years, this is not a fun if you want to be in that big ride. What they're looking for is that flat, stable 2, 3, 5% growth in a market that's just fairly just treading along water because they're built for income. The structured product risk understanding. Investors got to be comfortable with that complex payoff structure. This is not something that I can just say, hey, I'm going to sell this today and get my $25 or $30 price per share. You're not going to do that. You're going to have to basically put it out there, and they're going to tell you what they're willing to buy it for. So you have to work accordingly, and you don't want to be in and out of these funds. So who should avoid these things? If you're a growth-focused investor, you definitely want to be out of this. This is designed for a capital appreciation and not capital increase. Daily liquidity seekers. Auto-callables are liquid and not traded on exchanges. So you can't just expect, I need my money today. You're not going to get it. The complexity. Investors' structure involves multiple variables, barrier levels, observation dates, knock-in triggers. These are all different things that you have to understand. If you're not complex, if you don't understand these, I would not highly recommend you stay in these. And conservative investors, despite the market claims that this is downside protection, auto-callables are not principal protection in all scenarios. If the underlying asset falls below the barrier at maturity, losses can be mirrored as the market decline. So even though they always talk about that downside protection, it's really not as much protection as you thought. You could see a 30% drop off. You could see a 40% drop off. There is some cap to it, but not as big as what you think it would be. So the bottom line, this is a tool, not magic. I know there's people out there bragging about how this is a $100 billion industry. And I'm going to tell you up front, these are not investments that I personally look for. These are not things that I really am excited about. But there's been a lot of people asking me about auto-callable funds and how they work. So that's why we thought we'd put this together. So auto-callable funds are not good or bad by default. They are a financial tool designed for specific market conditions and investor profiles. If used correctly, it enhances your income compared to fixed income structures, such as like bonds and other things that you work with. The downside protection in a moderate market environment and the portfolio structure. So you got to find a suitable investment and investor match for the risk. If used incorrectly, unexpected losses, opportunity costs, capital erosion, and misunderstanding the product strikes. So guys, let me know what you think about this. Is this something even worth considering to look at, to evaluate? Just tell me what direction you'd like to see me go in this one. I'm at a point where I'm not real excited about these. I understand them and I see what goes on with them, but they're just not built for my type of investor. I like the ETFs that I know I could, even a bad one, I can sell and get some money back out of it immediately. That's probably the biggest thing I have against them. Let me know your thoughts in the comments below.